The last year has been bumpy for ESA investors as markets plunged. And now the banking crisis is adding another layer of uncertainty. Yet long-term performance remains strong. Many private investors will be wary of using their £20,000 stocks and shares ESA allowance before the deadline on April 5th, which is now just 2 weeks away. Yet if they don't act, their allowance will expire, and they will have missed an opportunity to build up long-term wealth for the future. All money invested in an ESA is free of income tax and capital gains tax for life, which means HMRC cannot touch it. This is an unmissable opportunity. One option is to play safe by putting money into a cash ESA. But over the long run, stocks and shares should make your money work much harder. Only if you give it time, though. In the short term, shares can be hugely volatile, and not for the faint-hearted. Nobody should invest in the stock market for periods of less than 5 or 10 years to overcome bouts of volatility, said Laith Khalaf, head of investment analysis at AJ Bell. Some of the UK's best-selling ESA funds have had a rough ride since the start of 2022, but have still made investors richer over time. AJ Bell's figures show that Fundsmith Equity, run by star manager Terry Smith, remains the UK's most bought investment fund. It now holds £23 billion, making it the largest fund of all. Smith has built his stellar reputation by running a long-term buy-and-hold strategy, investing in high-quality, resilient global stocks like Microsoft, L'Oréal, Estée Lauder and Visa. Performance dipped in 2022, but Fundsmith has recovered lately to deliver a positive return of 4.65% over 12 months. It has done much better over 5 years, though. Over that time it has delivered a total return of 67.46%. Somebody who invested 10 years ago would have done even better, making a total return 297.17%. That would have turned a lump sum investment of £10,000 into a staggering £39,717. Khalaf said, "No fund manager is infallible, but Smith has a great track record." The popular Scottish Mortgage Investment Trust is also a UK bestseller, but it has found the last year harder. Its net asset value has plunged 35.82% after being hit by crash in its tech stocks, which it was heavily invested in. Yet over 5 years, Scottish Mortgage has still delivered a total return of 49.29%. And over 10 years it is up 298%, matching Fundsmith Equity. That would have turned £10,000 into £39,817. Scottish Mortgage remains a bestseller despite recent troubles. But it invests in a high-risk sector, and there is no guarantee it will recover former glories. So think carefully before racing to buy it today. Low-cost index tracking exchange-traded funds are in favor among stocks and shares ESA investors, said Victoria Scholar, head of investment at Interactive Investor. Some ETFs charge less than 0.1% a year, while active funds typically charge around 0.9%. So you keep more of your returns. The Vanguard S&P 500 ETF, which tracks the stock market, remains one of the UK's best-selling funds even though it has fallen 7.67% over the last year. However, it is up 59.38% over 5 years and 216.35% over 10 years, turning £10,000 into £31,635. Much of this was down to the tech boom, and again, it may struggle to grow as fast over the next decade. Another hugely popular tracker, Issuer's Core FTSE 100 ETF, tracks London's Blue Chip Index, which has done well over the last year, rising 9.57%. Over 10 years, this ETF has returned 78.28%, turning £10,000 into £17,828. The FTSE 100 is playing catch-up after years in the doldrums, scholars said. It is full of solid, dividend-paying stocks in sectors such as banking, insurance, mining and consumer staples, which have held firm during recent volatility. Fidelity Index World is a one-stop shop fund that invests across thousands of companies in the US, UK, Europe, Asia and Australia, giving massive diversification. It is up just 0.39% over the last challenging year. But over 10 years it has returned 191.23%, turning £10,000 into £29,123. As ever, past performance is no guarantee of future returns, and your capital is at risk. Spreading your ESA allowance across several funds is safer than gambling on just one. As these figures show, stock markets are bumpy in the short run, but rewarding over much longer periods. If you don't want to pay a lump sum into today's market, many stocks and shares ESA fund platforms allow you park money in cash to secure your allowance before April 5th, and drip feed it into the market after that.